I want to talk about buying the narrative because you said something interesting preparing for this, Chris. You said that investors are narrative driven animals. What does that mean in practice?
I think a lot of investing is a confidence and a conviction game. What I'm trying to build in the diligence process is my confidence and my conviction that the forecast that we have for the business is realistic, that this company is going to hit numbers. And you're trying to kind of aggregate this mosaic of information that you're getting from a bunch of different channels and a bunch of different diligence motions that you're taking and aggregate all of that into, hey, your own personal conviction that this is a deal that I want to do. And this is a business that I want to be invested in. This is a team that I want to be partnered with, but also, the conviction that you have to build with your investment committee, et cetera. What I really meant by narrative driven animals, right, is we only have the ability to see so much and to gather so much in the diligence process. And so all of those pieces of information that kind of contribute to this narrative that helps us build conviction of, hey, like, what does this company provide to its customers? What's its value proposition? How strong is that value proposition? How well positioned is it within its market? And how strong a market is it? All of that is part of the narrative that we need to be buying into in order to get to conviction on a deal. And then you also need to believe that that team is going to hit numbers. We're trying to find and build a story around who is this company in its market? Why are they well positioned? And how do I build conviction that they're going to execute?
Do you find you need to have more conviction in the company itself or the market the company plays in?
It's a great question. I mean, I think the answer is both. Like, it's hard to disaggregate. In terms of like order of importance, market and product, then execution are probably the order in which I would put those. And I say that only because I've seen examples of great markets or great products lead to great outcomes despite execution that wasn't in line with forecasts. Hey, we found a business that's in a great market. It's in a very strategically interesting position within that market. A strategic decides that they need to own it, despite the fact that the company hasn't sort of achieved its LC case or hasn't gotten to like the level of scale that we were originally underwriting yet. Nirvana for us is all three, right? Like I want a great market with fundamental growth tailwinds. I want to find a product that sits at a really interesting strategic position within that market. And I want to find a team that's just going to go and execute to perfection. But I tend to think that great products and great markets can overcome execution, even if it's less than perfect.
And I come at this from the operator angle, Chris, where I've seen amazing teams with A-plus player talent, and they're just pushing a boulder uphill. The market won't take what they're trying to sell. And I've also seen it the other way, where it's like, you guys don't even know what day of the week it is, but you can trip 7 times and still end up on the 1-yard line. That's why I think even like if I was to pick a job, let's say I'm evaluating CFO roles, I would over-index on the market that the company plays in.
I think if you're in a great market and you have a great product, you have more room for error on execution is probably the way that I would put it. And I don't mean that to take anything away from the importance of great management teams. It allows you the room for error for sort of less than perfect execution.
Back on the narrative point, is there a danger ever that an investor falls in love with the narrative first and then they go hunting for this mystical company that they think can fit that narrative in their head?
In our position, you have to be really, really sober and realistic about what it is you're buying. The danger is kind of convincing yourself that what you're investing in is something that it's not. To be a growth investor, you have to believe that a business is going to look different and be much larger than it is today. That's inherent in the models, right? Because like we're not running LBOs where something needs to grow at GDP and basically make money off of great margins and cash flow. And so inherently, I have to believe the company is going to look different and be much larger than it is today. But that's a very different thing than convincing myself that a business is going to be fundamentally different than it is. And so like as an example, when we talk about conviction, when we talk about narrative, sometimes it works and sometimes it doesn't, but you see businesses that'll come to market that are looking for new investment. You'll kind of look at it and it's like, okay, they have a base business that's growing, whatever, call it, they're growing 10%. The way that they're going to sort of ratchet up the growth of it is basically with a new product that has just come out that has no material traction today. And they're asking the investor universe basically to value them as if that new product is established. Like that to me is a narrative and a conviction gap of, I want to believe that, but I also have to diligence where the business is today and make a risk adjusted assessment of where it needs to go in the future and how well positioned it is to do that. Like that's where valuation gaps can come into play. I'm asking you to pay a number that implies that I need to grow X, and today I'm growing 20 points less than X, but I have this new product that I'm just rolling out that's going to get me there. An inherent part of my job is that I have to be optimistic, but I also have to try to be sober and realistic about what are you today versus what I need to believe that you will be in the future.
I want to give you the flip side of that equation, right? Because operators can do this whole switcheroo too. Do you ever find companies that are leaning into narratives that they think are doing well to get funding? And you're like, dude, just do what you're already doing and what you know well, that's actually more credible.
I absolutely have seen that. I remember meeting with a business, it's probably 3 years ago, shortly post, call it ChatGPT moment. So AI was a hot topic. It's still a hot topic today. But I remember this business, this was in the GRC space. They had a compliance product that I thought was really interesting. Like I thought the value proposition was extremely compelling. Instead of talking about that, for an hour, we talked about an AI product that like basically was going to take all the comms of everything going on inside of a company and turn it into actionable intelligence. And it all sounded great. None of it was like currently existing. There was a massive gap in terms of like what I would be willing to pay for a business that I thought was legitimately interesting.
I'm so glad we got here in the conversation because something that we talk about on the show all the time is how do you bridge this credibility gap? I'm here, I'm saying I'm going to do these things to get me to there. You have dots along the way that eventually turn into lines. And this all comes back to forecasting. And one lesson that you mentioned in the lead up to this is that the way that you think about forecasting models has changed over time. You want to keep it stupid simple, it sounds like now. Can you just speak to how your philosophy around forecasting models has changed throughout your career?
The seductive trap that people fall into is assuming that complexity in a model equals sophistication or equals accuracy. I just have never found that to be true. And so I kind of have gone from when I was early in my time at PSG, when I was really the person building the models, like building these very kind of complicated forecasting models with a bunch of assumptions that were built into them that all in aggregate can build up to a really heavy impact on the output of the model. You're talking about layering 30 assumptions. I've come to a point philosophically, I'd much rather build a very simple model, right? Like I'd much rather have a one tab model that has 5 key inputs, and we've spent all of our time thinking about what are the right 5 inputs that are going to help me forecast this business. And 2, we've spent all of our time diligencing those assumptions so that we can have the most thoughtful and most informed assumption built into the model possible.
I often say that there's an art and there's a science to forecasting. I think the science is the P times Q. It's a deterministic model of, okay, just multiply this thing out. But I think the art is figuring out what shit matters. What are the 5 most sensitive parts of this business model? And then you have to go deep enough on each one. But it's very tempting to put 25 of those on the table and look like you get style points for it.
This is just a practical consideration for us, right? But like if I'm jumping into a model that somebody else has built, like wouldn't I rather have a one tab that I can actually audit and make sure there's not a bust in that thing? I think that AI capabilities will end up making a lot of the sort of modeling exercises relatively commoditized. And actually, I think in a great way, it'll end up freeing up time to think about the right key assumptions and then whether I have done the right diligence to get to inputs that are informed and thoughtful into, those 5 key things that need to be true.
It's somewhat related to what I often tell people about the annual planning process, that the process itself is more important than the plan. It's going through the exercise to think critically about something. But at the end of the day, if you can't also draw out, is this a good idea or a dog shit idea on the back of an envelope? Like you probably shouldn't be trying to build this complicated model anyway. So there is this level of rigor that you should go through, but there's also this, hey, we're pretty smart people here. We know the market. Is this something that we think is a big enough opportunity that we can calculate pretty quickly here?
You had the conversation with Paul Stanzik where you were talking about simplifiers and complicators. That would be a good example to me of, hey, like if you can't logically build the case for why this could be interesting and do that arithmetically, like just do some really basic math. You have to question whether it's a really good idea, but like I've always found those people to be amazingly effective that can very simple, very high level, like, hey, let's zoom all the way out. And then let's think about this analytically, right? Like you don't necessarily need to be good at math to be analytical. You just kind of need to break it down into its component parts and then think about those, make some relatively informed assumptions. And like pretty quickly you can come to a swag on a bunch of these things, at least for an investor, can help you triage pretty quickly. Is this something that I'm really interested in? Is it not? Similarly, I think in the CFO seat, is this something that we want to invest resources in next year? Is it not? Like, I think a lot of the investor mindset that can be applied to the CFO seat is really around making things as analytically and as ROI driven as possible. The questions that I'm going to ask typically in a board meeting about a new growth initiative are pretty simple, and they're almost uniformly going to be, what are your assumptions? Why do you feel good about those assumptions? And what does it say about ROI? And that again is where like, sort of narrative and conviction and track record then comes in, because like if I have been invested in that company for a couple of years, I know these guys are number hitters. So I feel very solid about when they tell me something and they believe it to be true, then I know that has a reasonable chance of being the case. It's a lot easier for us to say, yes, absolutely, let's go do it.
How do you think about analytical rigor in forecasting anything past, call it a year and a half?
I mean, I'd be curious if you would disagree with this, right? But like, I think when you were forecasting parts tech, like, would you actually feel great about a forecast model beyond, call it 12 to 18 months? Let's call it assumptions that aren't ill-informed, less driven by, I guess, by the reality of the business today. Part of the reason I think you can forecast a business with reasonable certainty over 12 to 18 months is because depending on the sales cycles, et cetera, like the pipe probably already exists. Like you've largely identified the growth drivers. Like you actually have things you could point at and go, I'm the CFO. I know exactly what my leading indicators are, and I know how good or not good I feel about this forecast. But your ability to say that with any confidence, I think, gets pretty limited when you can no longer point at defined pipe and you have to go, okay, well, like, how much do I need to create in the future? Where is that going to come from?
I do think you can very quickly get into this compounding assumptions. So the assumptions build on top of other assumptions, and suddenly you're 3 derivatives out from the original plan you were on. The math isn't wrong, but how credible is the management team behind it? And that's probably what I would tie it to, because I don't think anybody truly knows what's going to happen a year from now in any interest rate environment, in any tariff environment. If Claude wakes up tomorrow and drops a plug-in on everybody's ass, you just don't know what's going to happen then. But then you just got to tie it back to what's the say to do ratio of the management team you do have in those seats, who you think will also be in that seat more than a year out.
I think it's that. And then it's thinking about what the tailwinds that the business kind of naturally has, right? Like, to give an extreme or hyperbolic example, if someone were asking me to pay a price that implies the business needs to grow 15% per annum over a 5-year period, and they're sitting in a market that I believe is going to grow 25 to 30% a year over that period, like, makes it pretty easy for me to believe that this company is going to be able to grow 15% a year. Does that ever happen, right? Like that delta or that mismatch, like typically you're being asked to believe that the company's going to grow faster than the market. Okay, so like they're taking share. That's where I kind of come back to like, hey, I don't think I can forecast, or I don't think anybody can reasonably forecast a business with a very high confidence interval beyond 12 to 18 months. And that's where I want to spend my time thinking about how good is the market? How fast is that going to grow? How well positioned is this business strategically within that market? And to your point, like, what's my confidence and conviction in that management team and the execution engine that they deliver?
Scaling a tech company is thrilling. It's also really, really messy. Just ask anyone who's done it, or anyone who's tried. Better yet, ask EY. They've seen startups at their best and in their most fragile moments. EY knows you don't start a company to burn cycles on regulatory hoops, discounted cash flows, or the fine print of SEC Form S1. Although you probably do know I love myself a good S1 if you've listened to or read my stuff long enough. You can't ignore these things. That's how risk compounds. Kind of like negative interest. What you can do is work with EY from day one. They'll help you get it right early and often, so you can stay in builder mode and keep the trains running on time. EY, shape the future with confidence. Learn more at ey.com/tech startups. That is ey.com/tech startups.